Finance isn't just about numbers. It's about people, power, and the future of our societies. Is it a force for good, or is it widening the gaps it claims to bridge? In this episode of the Geneva Connection, we dive into how financial systems can drive prosperity, resilience, and equity. We'll explore tough questions. Can finance tackle systemic inequalities? How does financial inclusion empower marginalized communities? And what role do global financial systems play in closing the Sustainable Development Goals funding gap? Joining us are three leading voices on reforming finance, advancing inclusion, and bridging the SDG funding gap. Welcome to the Geneva Connection. Let's begin. In the first part of this episode, we unpack how today's financial structures widen wealth gaps and explore practical steps to reform the system. Joining us is Delilah Rothenberg, co-founder and executive director of the US-based nonprofit Predistribution initiative, PDI. Hi Delilah, welcome to the podcast. The top 10% hold 76% of global wealth. How do today's financial systems keep this imbalance going, and what can actually turn things around?
Well, thanks so much, Luka, for having me on this podcast. And it is a really great question. I actually went into finance in the first place because I was interested in attracting capital to underserved areas of the world, like sub-Saharan Africa or to small, medium-sized enterprises. And I didn't know anything about finance when I first started, so I ended up in sell-side equities, and I was at Bear Stearns during the financial crisis on the trading floor of all things. But by that time, I had learned about different asset classes, and I thought that perhaps going into private capital asset classes like private equity and infrastructure could help direct capital towards solutions that I was interested in. And so I ended up going into that space. And what I observed really helped shape the vision of my current organization, the Predistribution Initiative, or PDI, as we go by for short. So for instance, when I was doing work in sub-Saharan Africa, you could see how so much return, when you do an investment on the continent, actually leaves the continent. And, there's a narrative that you're creating jobs locally, but are those really well-paid jobs? What is that worth relative to the return that's going to the foreign investors? How are the investors thinking about risk in this place? And how does that magnify their return? So that was sort of one instance where I saw sort of inequality growing systemically, even as we were sort of shaping these investments to be impact investments on the continent. Then later, I ended up working in private equity focused on more developed markets. And I could see how a lot of private equity investments are structured in ways that result in enormous returns for the private equity fund manager. Competitive returns, I think many would argue, for the ultimate investors, the asset owners and allocators, or limited partners, as they say in that asset class. So for those of your listeners who aren't familiar with that space, think about pension funds or sovereign wealth funds or insurance companies or endowments. Those are the kinds of investors that invest into private equity funds. So you've got a lot of return going to the private equity fund manager. You've got returns going to the asset owners and allocators. But who's on the ground creating the value and taking the risk? The workers, right? Or if you're doing an infrastructure project, communities give up access to ecosystem services and their land for future generations or current generations to house that infrastructure project. But so often workers and communities don't participate in the equity ownership of an infrastructure project or a company. And yet the executives of companies do. And that's one of the reasons why we've seen CEO pay go up so much, particularly in places like the United States, but I understand in other geographies, particularly in the developed world as well. And so, for instance, in the US, we've seen CEO pay rise by over 1,000% since 1978, whereas worker pay has risen by only about 24%. And that could really change if workers and communities got to participate more in equity ownership. So it's one element. It doesn't explain the disparities overall. Yes, there are historical imbalances from colonialism that need to be addressed, and not everything can be addressed through what we're calling predistribution, right? paying workers more and communities more for the value that they create and the risk that they take. But I would say that it's a big part of the solution, and it's an important area to focus on. But yes, let's level the playing field as well, from historical imbalances, from colonialism, from different disadvantages from different groups. So there's a lot to look at there.
Do you think systemic change is possible? And if so, what are the most urgent steps?
I do think it's possible to change the system. One of the foundational building blocks that I think is really critical is thinking not just about financial capital in a transaction and the risk that it takes and the value that it creates, but really acknowledging that financial capital, it's sort of like money, right? Like, why was money created? It's supposed to represent some sort of real world value, right? And one would think that financial capital should too. So what's real world value? It's people, it's nature. But financial capital has become so disconnected from what it's supposed to represent. And we can see how the financial economy is doing really well. The financial markets are doing really well, even while people are suffering and the environment is deteriorating. So something's really wrong there. And I think a solution has started to emerge over the past decades in an acknowledgement that it's not just financial capital that takes risk and creates value, but it's human, social, and natural capital as well. And if we can value those capitals and we can consider the risk that they take and the value that they create in a transaction, then that changes the way we think about distributing risk to people in nature and the return, for instance, to people, or if structured a certain way, even nature. So fundamentally, I think that there are a number of interventions, like there's the Capitals Coalition, who's here at this conference. They're doing a lot of great work with companies to reform corporate accounting to better value human, social, and natural capital. And we're also part of another initiative called the Externality Investment Research Network, which is going to be working on solutions for diversified institutional investors to understand how systemic and systematic risks hit their portfolios and by how much, how, when, by how much. Because we don't really have tools in the financial services sector or in capital markets to systemically risk adjust returns. It's really based on what's the risk return profile of this particular investment, right? What's the risk to that particular investment or issuer of a security? But we don't think about the risk to our systems, our human and natural systems that we're dependent on. And that risk should be factored into how we think about the value of a particular investment. If you say, this investment looks attractive, but it's going to create all this systemic risk that's going to hit our portfolio in the long term, then that could make what was previously considered concessionary, taking too much risk for a particular return, it could make it look commercial.
How can finance balance urgent social needs such as poverty with long-term goals like climate action?
Well, I hope that what I say is not too unpopular, but it is a little different than I think the way we've been doing things. And people really need to come first, right? We embrace at the Predistribution Initiative a motto from the disability rights movement, nothing about us without us. That was mentioned at the Building Bridges conference this year by a member of the audience from South Africa. And it's so important because you can't come up with solutions to environmental issues or to climate, to nature, without bringing people along, right? If the solutions are only developed by people who have the economic security and the power and the agency, then they're not going to come up with a solution that works for other people because they're not informed by what other people's challenges are. And so it's really critical that we address wealth inequality early so that we can support people in building their economic security and agency and voice to participate in solutions alongside those of us who are more privileged to be in spaces like this. And I don't think it's just addressing wealth inequality that is going to solve this problem, but we also have to show up in public spaces with a sense of humility and empathy for people who might not seem to share our values or our perspectives. And only then, when we really start to respect one another and ensure that people feel economically secure, do I think we'll really be able to co-create meaningful solutions for climate and nature. Because right now we're seeing a lot of pushback on climate and nature. Even when it comes to inequality, there's a lot of focus on this marginalized group or that marginalized group and who's the most vulnerable and who's the most marginalized. And that can be very distressing for people who do feel marginalized and less advantaged, because they're like, am I going to be considered the most vulnerable or the most marginalized? And it sort of pits different groups against each other. And it also just reinforces existing power imbalances. And I think that there's this whole narrative. I think redistribution is really important for addressing historical imbalances like we talked about before, and for funding infrastructure and social infrastructure and government services and aid situations. But we should not be dependent on redistribution for ensuring that people feel economically secure on an ongoing basis. We need to fix the systems through which wealth is created in the first place so that the returns are more evenly distributed. And so that is just really critical toward addressing any systemic or societal solution.
Let's talk about your work. What are the biggest challenges you face and how do you overcome them?
Our work is very technical, and maybe that will come through in some of what I'm about to explain about our work. But I would also say that for all the sort of technical adjustments that you can do in the financial system, at the end of the day, power and concentrations of wealth, unfortunately, are celebrated widely across cultures. Not entirely. I mean, there are certain pockets of society around the world that don't celebrate concentrations of wealth and power, but we tend to venerate people who have made a lot of money, and we think that they're powerful, and we enable that. We think they have all the answers. They think they have all the answers, and that reinforces some negative dynamics in society. And so I do think that at the end of the day, there are some cultural shifts that we need to work on to really celebrate more predistribution and not so much accepting that it's okay to play the game of capitalism your entire life, make all this wealth and concentrate it, and then be celebrated for giving it back based on your own worldviews, right? We are focused on financial services, and I did work in financial services for 16 years before starting the Predistribution Initiative. And I don't think people in financial services or even wealthy people are bad people either. And so, I think everybody has to show up with a sense of empathy and just understand that we're responding to incentives and the culture that we were raised in. Now, the Predistribution Initiative doesn't do that work. There's only so much we can do. And what we do is we have 3 work streams. So we have one work stream that's focused on measurement and evaluation. And that's really doing research to map the pathways through which investors themselves, not the portfolio companies, because a lot of work's been done on that already, but the way the investors themselves contribute to impacts and risks and opportunities in society and in their portfolios. And so, for instance, I think there are major blind spots in the sustainable finance space, sustainable and inclusive finance, in terms of looking at how investors structure, price, and allocate capital, and how that can lead to certain inequalities, right? So we're doing research to map those pathways. And then we're also doing research to help these investors understand how those negative impacts related to inequality show up as systemic or systematic risks in their diversified portfolios. And that incentivizes a change in behavior. Then our second work stream is, okay, you're measuring things differently, right, as an investor. So what does good look like? How should we change our behavior? And so we're working to educate investors on how to better value human, social, and natural capital, to really understand how to systemically risk adjust returns. Now, I hesitated when I say that because we don't have the answers. So it's not like I shouldn't say we're educating them, but we're developing forums for these investors to come together to co-create solutions to be able to systemically risk adjust returns and to consider human, social, and natural capital in the way they think about value, which again, then shifts the way we think about risk and return.
How open are investors to rethinking value and risk in finance?
I think that they're intrigued. They're interested. They know that they have a problem, right? And I think everybody is really waking up to the risks of climate change. There's more and more attention on nature loss. And particularly with some of the polarization that we're seeing come up around the world, which is leading to unhealthy levels of protectionism in many cases, to domestic conflict, to trade wars, activities that exacerbate geopolitical conflicts, and all that can lead to inflation, right? And price stability, and it's just not good for markets. I think we're seeing that investors are also starting to take inequalities seriously. And so the question becomes, what can they do about it? And I don't think anybody really has, perfect answers yet. And so they're searching for answers. And I think a lot of these investors are held back, particularly the allocators, because they are incentivized to meet or exceed financial benchmarks that have not accounted for externalities, that have not adequately valued human, social, and natural capital. So the financial benchmark that you're using to evaluate your own performance that you're trying to meet or exceed might be inflated. And so if you want to invest sustainably moving forward, and you want to more adequately value human, social, and natural capital moving forward, are you going to be able to get the same returns of the past? And so that just, it doesn't mean that we should take a concessionary rate of return. It just means that we should think about value differently. And so I think investors are intrigued by that. They want to do the right thing. They want to overcome that sort of barrier, but they don't have the tools yet. And we don't have the tools ourselves either, but we're creating this space for investors and academics and other specialists and groups like the Capitals Coalition and the Externality Investment Research Network to come together to co-create these solutions.
How important is educating the next generation of investors?
That's a great question. The younger generation is really important. And I think that the key area for change for the younger generation is in business schools. And we need to change the curriculum so that these students really think about the fundamentals of finance differently. Within investment institutions, I think the younger generation can be change agents, and that's really important. But I also think that engaging leaders at the top, the trustees of asset owners and allocators, board members, chief investment officers, is really, really critical. And one of the blind spots that I think we have is that we so often focus on engaging with sustainability professionals, and a lot of sustainability professionals have really important experience in environmental or social issues, but they haven't been adequately trained in finance to really understand that their investment team counterparts might be incentivized differently because they're trying to meet or exceed those financial benchmarks that don't account for externalities. And so you often have two sides of an investment house that are sending mixed messages to their investees downstream, to their asset managers and to their portfolio companies. And you have one team saying, I want you to treat your workers better and, treat the environment better. And then you have another team that's saying, oh, but you have to still make these enormous returns. And the two are in conflict. And so that really needs to be addressed. And so that can be done across generations. But yes, I agree. Younger generations is really important.
Finance often feels like a foreign language, technical and confusing. Is that complexity part of the problem? And how do we make it easier to understand?
Yeah, the complexity is really a problem. I think the one work stream that I didn't mention earlier in our conversation, the last work stream that we have, is on more innovative investment structures. And that's where we're looking at solutions that interact more with the real world. So for instance, community ownership models, community members owning some of the infrastructure project that's in their community, or workers owning equity in the company that they work for. And I think that those kinds of examples are good starting points for people. Or there are alternatives to venture capital for small, medium-sized enterprises now, like revenue-based financing, right? And that's a good opener for entrepreneurs or small, medium-sized enterprises that don't have that hockey stick style growth that venture capital requires. And so if you talk about these kinds of opportunities and you can share case studies and do YouTube videos, right, that show people that they could own equity in their company or in the project in their community, or that there might be another solution to access financing for their small business. That's a good entry point, I think, for people to learn about the type of work that we're doing and to bring them into this movement.
Delilah, thank you very much.
Thanks so much, Lucas.
Financial access is key to economic opportunity, yet millions, especially women and undeserved communities, remain excluded. Financial exclusion limits opportunities, deepens inequality, and leaves entire communities behind. How can we bridge this gap? To explore this, we're joined by James Mwangi, a Kenyan banker and entrepreneur, and the CEO of Equity Group Holdings. James, welcome. 1.5 billion adults remain unbanked. 56% of them are women. That's a massive barrier to opportunity. Is this a systemic failure, or is there more to it?
Thank you very much. It's a very sad state. It's a shame that at this time in the history of evolution, of development of humankind, would have exclusion of that nature. Financial services and empower and enable people to realize their dreams. So when you are excluded from financial access, it means you are condemned to a life where you are not able to pursue your dreams of self-improvement, self-investment, or to participate in economic activities. So it's a tragedy to talk of 1.6, 1.5 billion people being excluded. But it's even worse when you talk of it in a state that women are the majority of those who are excluded, because women are anchor families. And truly, the access to finance by women help them to nurture families. So it goes beyond the individual exclusion to exclusion of households at that level. I think the issue of dealing with this challenge needs to be an urgent issue. We need to address it because it continues to marginalize people and increase inequalities in the world. Because financial access is equal to access to opportunities. So when you are denied access to opportunities, it means you are left behind. And this time in the development of the world, the worst we could do is to have a state where there is no inclusivity in opportunities, because we know the adverse effect. So where do we start? I think we start by taking this access to financial services as a human right. If it's then a human right, it's then an entitlement for everybody. And it can be dealt at policy level, such that whether it's the UN decisions, whether it's a policy decision by government, it is a priority and it's enacted as something that should be enabled. The second aspect of addressing it is prioritizing it, whether it's the civil society, whether it is foundations and philanthropists. If there are barriers, then we need to remove these barriers, such that it's not just about financial inclusion, it's looking at the root cause of these challenges. So it then becomes the responsibility of all, the banks themselves, the financial institutions themselves, the philanthropists. And broadly, if we can adopt blended finance, I think we could address these challenges. And blended finance will only happen if all of us are working together. Development bank, philanthropists, commercial bank, grant makers, states, so that we have all the tools together in a manner that we have a comprehensive and integrated solution of dealing with this problem.
Many see financial inclusion as a cost rather than an investment. How can banks balance inclusivity with profitability?
I think the balance between inclusion and profitability needs to be addressed by broadening the concept of profitability. We need to go beyond financial profitability to looking at impact as part of profitability. We need to see the issue of communities and societies as part of the stakeholders. And we need to stop seeing spend on communities as an expense, but as an investment. So if you take it as an allocation, then you add it back to the bottom line. People have talked in the past about the triple bottom line of people, profit, and the planet. And that if you look at it that way, then we are able to reconcile the bottom line and sustainability through inclusion.
Here at Building Bridges, we focus heavily on climate and nature finance. The African continent is absolutely critical in the fight against climate change, with its vast natural resources and immense potential for nature-based solutions. But financial exclusion remains a significant barrier for many communities to fully participate in and benefit from these initiatives. From your perspective, what can be done to change this?
It is true, financial exclusion denies communities in Africa to utilize the resources at their disposal, whether it is land, whether it's energy, whether it is natural resources, to better themselves. You require finance as a catalyst and a stimulant for economic activities. So when this is lacking, then you start to do the light opposite of marginalizing communities and having resources. As a result, you then see predatory behavior, where communities are not able to develop their resources, but those with access to financial resources adopting an extractive approach to the resources, because resources are required for development. What it means is that host communities then don't participate in economic activities, in fact, fueled or powered by their own resources. And essentially, that then creates the situation we find in Africa. The timing is for Africa seems to be right, where if Africa puts its act together and focus on using the resources it has, whether it's land, whether it's renewable energy, whether it's clean strategic minerals, whether natural nature and natural resources, then it could be able to negotiate with the rest of the world. And we develop Africa using a shared prosperity model. I think it is imperative for the world to recognize that sustainability of the world is tied to the transformation of the African continent. And the transformation of the African continent means lifting a lot of people out of poverty, giving decency to the lives of a majority of the population in Africa. And essentially, it helps to build bridges between Africa and the rest of the world, and hopefully heals the wounds of what Africa has gone through in the past.
James, thank you very much.
Thank you.
In the final part of this episode, we zoom out to the global stage. With a $2.5 trillion funding gap for the Sustainable Development Goals, the SDGs, how can international financial systems address inequality and drive transformative change? Joining us is Jean Pem, Global Director of Finance at the World Bank, where he leads efforts to build inclusive and sustainable financial systems. Jean brings a macro perspective on the role of partnerships between governments, the private sector, and civil society in fostering resilience and equity. Hello, Jean. Welcome to the podcast. Your work at the World Bank is essential in mobilizing global financial systems to tackle inequality and close the SDG funding gap. So let's start with the big picture. The $2.5 trillion annual funding gap that developing countries face to meet the SDGs. With such a massive shortfall, how can the international financial system step up to address global inequalities and make real progress in closing this gap?
First, thank you very much for having me in your podcast. Second, that's a big picture question. So indeed, the bank is a very important player in that global financial architecture. You may have seen that over the last month, the bank has done a lot of work to become what is called a better bank. So some of it is about being more efficient, quicker, respond to the urgency of development challenges in our client countries, and they remain quite demanding. And at the same time, also mobilize further its balance sheet. And there's been a lot of work, first on the risk aversion of the bank, the ability to take risk in terms of credit risk to a large extent. We are a bank after all, but also to something that is related more directly to your question, which is leverage the balance sheet to provide risk sharing to the private sector, to private investment. So One of the highlights of this new way of doing business is around the guarantee platform, which is a way to consolidate and rationalize the way the World Bank Group, so it means the bank as a bank, IBRD and IDA for the low-income countries, IFC, which is the private sector arm of the bank, and MIGA, which is the guarantee institution of the bank. So there were different products. All of that is better coordinated under one platform, and it's exactly about what you described, which is to provide risk sharing to the private sector to attract more private capital. The second element that is very important in your question is that we sometimes focus a little too much on cross-border investment. So how can we bring private capital from advanced economy, to use our terminology, to emerging market? And it's really important to do that, but there are also specific risks. So one of those that is very often mentioned is exchange risk, and how to address the issue that you are in a foreign currency when you're a private investor from outside, and that sometimes the revenues associated to a project are in domestic currency. So then you have a currency mismatch, which can be a major risk. So we are trying to find solution in that direction. But one of the very important elements of that discussion is about the development of domestic capital market, how to bring the private capital of the countries themselves as the first layer to some extent, and also, which means supporting institutional investors. So the work on pension reform, the work on the insurance sector, but also providing instruments so that you can channel that private capital, domestic private capital, to various investment. So we are doing a lot of work on that. The bank is not the only player, so a lot of that is also in coordination with other bodies. So inside the bank, we have a joint initiative between the bank and IFC on capital market development. We are working a lot with our colleagues at the IMF, including on the agenda, which is called domestic resource mobilization, which is really help mobilize these public and private resources domestically. And of course, with other development partners, in particular, other multilateral development banks.
Financial inclusion is often mentioned as a key driver of prosperity and resilience. Why is it so crucial for building stronger societies?
So financial inclusion is very important. Think about it yourself. What would you do if you couldn't have access to a bank account? What would you do if you couldn't have access to insurance products? What would you do if suddenly you were faced with a shock, earth shock, something happening in the country, and you cannot mobilize funding to be able to absorb that shock? You lose your job for 3 months because an earthquake happened. How do you survive in that context? So it's really about that fundamental element of access and usage of financial services, all of them. It goes from payments to credit to insurance, and in the case of firms, also to equity financing, making sure that irrespective of where you are, irrespective of your income level, irrespective of your gender, irrespective of your age, whether you live in a city or live in a rural area, you have access to financial services. So that's the fundamental principle. And I'm making on purpose a distinction between access and usage, because we see quite a bit of examples where people may have a bank account, they actually don't use it. When they receive money, they cash out immediately. And then you lose the ability to have information on who they are, on their behavior as a financial sector customer, which is a way to build credit history and things like this. So we are looking at all of that as a total set of services to some extent. So why does it matter? So the first element is that if you think about a company, a firm, an SME, the only way for them to grow is to have access to financing. So usually when you don't have access to financial services, then you finance that internally with the savings of the family, etc. But it takes you that far. So for the companies that have really the ability to grow, that access to financial services, equity and debt is really important. But there is also the element of reducing the cost of transactions. So we are all seeing the transformation of the economies thanks to digital. But doing full-fledged digital, then you need to have access to digital financial services. So very concrete example, you order something online. If you cannot pay online, then it's more complicated, it's more expensive, you are losing efficiency. It's not impossible to do. And you can have pay on delivery, but it's more complicated. So we have all these very specific elements in terms of jobs and growth. One data point, we recently issued a study on productivity through firm financing that showed that in emerging market, when you provide access to financial services, you have an 86% productivity improvement at the level of the firm. If you want to create jobs, you need to increase productivity. And we have been able to evidence a direct link between access to financial services and productivity. Second big priority, gender. So we've seen quite a bit of improvement in terms of access and usage of financial services, in particular thanks to COVID. So clearly the digital financial services has changed the picture. But we still see a gap between male and female access to financial services. We also see that in some countries, they've been able to close that gap. So it's doable. So it's possible to do that. And then what we are looking at are the countries where there is still a gap or where the catch-up has not taken place. So why do we do that? Because it's about agency and women empowerment. If they don't have access to financial services, if they need to depend on their husband, their brother, their father, etc., to be able to themselves mobilize financial services, either to grow a company or from a resilience perspective, then we are not going to be able to bring a woman to include them completely from a social and economic perspective. So we recently announced the new gender strategy of the World Bank, and there were, during the annual meetings of the World Bank and the IMF, a specific target. We committed as the World Bank Group to provide access to capital, so equity and debt, to 80 million women and women-led companies, firms, by 2030. So that's a very ambitious target. And it's on purpose focused on access to capital, which is about growing their own company and therefore being able to have more labor force participation, more companies led by women, but also providing services to women. So that's really an important element. And then finally, when you think about eradicating poverty, part of it is also how to manage risk, how to build assets, how to invest to improve their well-being, and it goes from education to health, etc. And that's where financial services also are really important. So there was a study done in Mexico that showed when you had a 10% increase in financial inclusion, it led to a 7% increase in job growth and a 3% increase in GDP growth. So really a very strong link between financial inclusion and the fundamental elements of tackling poverty and eradicating inequalities.
You mentioned that financial inclusion is about both access and usage. Can you tell us more about how the World Bank works with its client countries to promote financial inclusion? Maybe share some concrete examples.
Essentially, we mobilize three kinds of instruments. The first one is policy advice, which is to dialogue with the client countries. So in the case of what my team does, the counterpart are essentially public sector counterpart, so central bank, financial sector supervisor. And we work with them on improving the regulatory framework, the rules of the game for the financial sector, so that you open it to new entrants. So a very good example on that is digital financial services, the so-called fintech. So fintech actually is a bit of a buzzword. It's both a transformation of existing financial institutions, but also bring new players. We've all seen that in every country in the world, but sometimes there are very important and not so easy debate on how do you open the financial sector to this new player? What can they provide? How do they do it? How to provide a level playing field? So we work a lot with the client countries on that regulatory framework, more competition, opening the market in a way that is sound, safe, and also protects the customers. Then another part of the work related to that is what we call financial infrastructure. So on the information payment system, it seems easy from your phone to say, I'm going to send you $50 or 50 Swiss francs. What's behind that is actually pretty complex. Who are the players? How to make it work? How to provide securities to that? Cybercrime is one example of the things that you need to think about. So that's one thing that we are doing. And we think that it really can change both financial inclusion, but also the way people are doing business. So let me give you an example, which is the digitalization of cash payments. So when you saw social transfers, in a lot of countries, it was still done cash very recently. So that's where COVID changed the picture. But then what we are trying to do, working with our colleague from social protection, is how much can we digitalize this transfer as a way to bring people into the financial sector to also target better. But then, again, they build a kind of financial sector history, which allows them to have access to more services. So that's an important part of the work that we are doing. So the second element is mobilizing our own funding. So we work with financial institutions. We work with what we call wholesale financial institution on providing funding so that we can tap parts of the market that otherwise are underserved. So that's where we go back to that discussion on women MSME or new ways of doing business. So we have a couple of projects where part of it is to channel funding to SMEs that want to become more green, more sustainable. And sometimes it's still perceived as a risky business, so the banks don't go. So we are trying to come with creating markets to some extent, but also doing demonstration transactions so that it can work. So let me give you an example. In Kenya, in December 2023, we approved a project called the Jobs and Economic Transformation Project, which benefit 45,000 Kenyans, including women, through new and improved jobs prospects. So there is a component that is capitalizing a green investment fund so that we can really assist and mobilize domestic private capital to be able to channel funding to SMEs that want to become more green and that were not served by the traditional financial sector. And then the bank operation helps them to do that. So that's the second element. And then the third one is knowledge. So we are doing, it's not research, but it's more collecting the best practices, the emerging practices, what works, what doesn't work, as a way to inform the community as a whole on what can be done better in terms of financial inclusion and access to financial services for SMEs.
I imagine that expanding financial inclusion at scale also requires private investment. What is the World Bank doing to encourage more private sector involvement in this space?
So let me step back, coming back to that discussion on the World Bank Group. So MIGA, this guarantee agency, works with the private sector. IFC's business is to work with the private sector. So we already have two very important entities who are dedicated to bring more private capital to emerging markets. But the World Bank is not just public sector, not working with the private sector. So first, we work a lot with our colleagues from IFC and MIGA, but also we are following what I just described in terms of policy reform, lending, and knowledge. We are also really doing it in dialogue with the private sector and in a way that is creating more opportunities for the private sector. So a couple of examples. Regulatory reform, what I mentioned earlier. In Mexico, we supported the development of a fintech law. Thanks to that, new players could come to the market, and in particular, we had 52 e-money service providers that were new entrants into the market. So one opportunity, which is more private investment. All of these are private companies. And at the same time, broadening the range of financial tools that are offered to the public, both household and SME. So that's the kind of things that we are doing in terms of working with the private sector created space. We see a lot of countries where you sometimes have a bit of resistance of the incumbents to this new player. Then we have a dialogue with the authorities on how they could open the market, do it in a way that is not creating more distortion. So competition, for instance, is an issue that is much more present in the financial sector than it was a couple of years ago. Look at the role of big techs. Big techs, they are providing financial services, but they can also integrate the provision of financial services with the rest of their trade, which can be very good, but sometimes can also create situation of de facto monopoly of things like this. So these are elements where we have dialogue and capacity building of the financial sector provider. But we want to do that in a way that is responsible. So we are working a lot with the financial sector supervisor on consumer protection. How do you ensure consumer protection? How do you do financial literacy? How do you do financial indication? You don't want to give more credit to households and then they end up over-indebted. So there is that balancing act and making sure that the products are well designed, but also that the customers understand what are the risks associated. You cannot do business in the financial sector without an element of risk. So that's one example. The second example is about this financial infrastructure and digital financial services. So I'm going to focus on open finance. Open finance brings a lot of potential because you can leverage the data that is associated with financial transactions. It's a lot of information. So on the one hand, it can open new opportunities, including to reduce financial inclusion, but also to provide credit. You have much more information on your counterpart. You better understand your credit risk. So therefore, you make more informed credit decision, which hopefully will assist in improving access to credit for firms. But you want to do that in a way, again, that is safe, responsible. So consumer protection, come back again. Data protection, extremely important. Also cybercrime, cybersecurity, how do you embed that? So this is an example where we create market. There are many new players, stakeholders, when you think about open finance. It also requires public policy that are pretty clear, and at the same time, giving the opportunity of new service provider, new players to come in. So that's another example. And then finally, coming back to the lending, we are really trying to attract private capital through three ways. One is the pathfinder role. So the bank coming with funding to address segments of the market which otherwise were not covered. And then you show that it works and you bring the private sector. So we've done quite a bit of work on what is called early stage finance. So how to support startup very early in the process at a time where the risk is very high. So there is a very good example in Jordan where we work with the authorities to create a startup fund, a startup SME fund, to which the bank provided $50 million, and we're able to leverage $78 million. So we want to increase the leverage ratio, but that's an example. And then after that, we exit and it works on its own, including by mobilizing the domestic private sector. The second element is new financing models and ways to channel investment. So we did something very interesting in Rwanda recently, working with one of their national development bank, the Development Bank of Rwanda. And that bank issued its first sustainability-linked bonds. And what we did is to provide risk sharing to some extent. So we used the proceeds of the bank loan to be able to reduce the risk for investors and the borrowing cost by collateralizing the bond. And they were oversubscribed. They started with the domestic investors. They are preparing a new issuance. So part of it was to work with them on how to structure that. So it was done by the financial sector team, but also the treasury team at the bank, providing that risk sharing, so what we call the risk finance angle, and then learning out of that for the Development Bank of Rwanda, and now they can replicate the transaction. And of course, now we have other countries looking at what's been done in Rwanda and saying we're interested to do something similar. So this is also how we bring private sector. And then finally, the de-risking of investment in the most challenging markets. So this is what I mentioned earlier on that guarantee platform. This is also things where we can provide de-risking to domestic players. So we work with guarantee companies, we capitalize guarantee companies so that they can provide a de-risking to local transactions. And that's a way also to have more leverage. So it's an indirect intervention. We don't distort the market, but it's a way to improve the risk sharing and push the financial institution domestically to go to part of segment of the population which otherwise would not be served.
Here at Building Bridges, we're talking both about opportunities and challenges. From your perspective, what are the 2 or 3 biggest obstacles to advancing financial inclusion and how can they be tackled?
I think there are 2 ways to look at it. One is one of the lessons learned of what happened during COVID and somehow the improvement in financial inclusion is that digital is really a game changer. And you still have countries where there is still a little bit of reluctance and hesitation to opening the market to digital financial services. So that we need to continue to push the envelope, bring these new players. That's where open finance come in, etc. And then you have categories of the population which may be harder to bring under the roof and where we need a more deliberate, systematic approach to address some of the challenges. So I mentioned earlier, urban-rural divide, there is a youth divide, and there is a big gender divide in some countries. So then we need to be much more deliberate, much more targeted. So it's not rising the tide for everybody. It's really having systematic approaches on these categories of population to unpack a little bit what's happening, but also to find new products, new service providers. So you go less through banks, you go through microfinance institutions. There was a lot of discussion in the past on agent banking, how to have people who are closer to the customers. And then there is the challenge of women financial inclusion, in particular in countries where we end up around the social norms discussion, where we can do that a little less as financial sector, but we mobilize our colleagues of social protection, of inclusive growth, etc., so that we bring the elements together. But sometimes it comes to very specific intervention. So I have in mind something that our colleagues at IFC are doing, which is called Women in Banking, where part of it is really work inside the financial institution to train the people in contact with the customers of how to make the user experience much more positive, but also sometimes women don't want to bank with men. So you need a teller who's a woman. So then you go extremely granular, very micro. But that's really a way to make a difference. But also the design of the product. So, okay, as a man, I can probably say it, we have unconscious bias. Sometimes the design of a product may work for a man, it doesn't work for a woman. So then you need to unpack that. So you need a mix of macro intervention, better data on what's really happening. It's actually very difficult sometimes to unpack from a data perspective, and then work with the financial institution themselves. And then on the other hand, financial literacy, providing more opportunities to have access to financial services, etc. So you need to work both on supply and demand.
Jean, thank you very much.
Thank you very much for inviting me, and a pleasure with the discussion.
And we've come to the end of this episode. Thank you for listening. Join us next time as we dive deeper into transition finance, mobilizing capital, driving real impact, and shaping policy for a net zero future. And if you don't want to miss it, please subscribe. Bye for now, from Geneva.